The Federal Reserve makes a major announcement today, keeping the key Fed funds rate unchanged. No rates going up, certainly not going down, not just yet. What does that mean for the economy, multifamily and real estate? We're going to talk about that. But also, so much economic data has been coming out this week of December. We have the CPI to talk about from the Bureau of Labor and Statistics, but also some 2024 outlooks and predictions. One from Colliers, one from Cushman and Wakefield. Really interesting. A piece from Globe Street. Prediction. Multifamily distress will start in the second half of 2024. That might make sense. Is the distress already starting? Do we just need to be more patient? And will it ever actually emerge? From BizNow, CRE marketing jobs on a chopping block amid industry slowdown. And also from the Harvard Joint Center for Housing Studies. Hey, move over, millennials. Gen Z is driving rent demand. Fascinating. And one more piece, if we have time for it, because it involves AI and, it's a buzzword and, take it or leave it. From JLL, how AI is revolutionizing commercial real estate. Really? Is it? Well, let's talk about it. Let's find out. If you're a multifamily investor, any kind of real estate investor, well, welcome. You're in the right spot. This is the YouTube channel, the podcast, where we are keeping you up to date with all of the latest research reports, data, some original insights from the Gray Capital team, joined by Dr. Matt Bosnagel. He's the producer of the Gray Report, and not just a podcast, the best newsletter. He's a director of communications and marketing here at Gray Capital. My name is Spencer Gray, president and CEO of Gray Capital, as well as host of the Gray Report. We're live from Indianapolis at the Gray Capital headquarters and studios. Let's get into it. Welcome back to the report. Joined again, Dr. Matt Bosnagel. How you doing, Matt?
Pretty good. I'm. This is an exciting. December's not meant to be this exciting.
Sure it is. We got all kinds of stuff. I mean, we've got what is it? We got Boxing Day. We got Hanukkah. We got Christmas.
That's true.
Flag Day.
Those are all not
Flag Day.
For like multifamily and CRE, it was like take December off. Nothing's gonna happen.
Everyone's getting there. Usually, everyone's trying to get deals done before the end of the year. There's a rush to do deals, and there certainly is. I mean, there's been incredibly low volumes. Yeah. I'm interested to see what the volume in Q4, is going to end up looking like. I know some deals are closing. I'm sure it's still way below, historical average, but it would be curious to see if there is a little bit of tick up.
Yeah,
kind of thought that there might be a little bit.
So we were talking, Addison and I last week about it, and we pulled up. CoStar has Q4 at half the sales volume as Q3, but then if you look in the past, every single Q4 has always been a little higher than any other month.
And also Q4, it all pushes to the end of December. A lot of those deals are, right just at the end. Yeah, exactly. Just people trying to get deals done, and then some are getting kicked out into next year. So what that sales volume will end up being is going to be really interesting. Yeah. A lot of anticipation for 2024, Matt. We're going to get into some outlooks, but you guys doing Elf on the Shelf this year? You and your kids, family, you guys? That's what you guys do?
We haven't. We've never done.
I think we've talked. Okay, we've talked about this. No,
but
it's a lot of work.
Yeah, and it's
a lot of creativity.
Yeah, I think it would be creativity, but it's also like I'm scared of if my kids would be terrorized by the elf, or if I would be terrorized by the elf. It's a lot of expectation.
It's probably they're probably too old to throw it at them right now. Yeah, because they'd be like, where has this thing been?
Yeah.
So I get it. Well, I just had to ask Matt. But yeah, no, we're at a very interesting time in the economy and commercial real estate. Yeah, I think there's signs that the time to buy is going to be like coming very soon, as the idea of interest rates, if the Federal Reserve begins to cut, most consensus, and I was looking at the forward curve a minute ago. At some point next year, the Fed funds rate, may start to be cut. The stock market is certainly anticipating that, and the bond markets as well. But, if and when and the severity, I think that everyone is pretty impatient to see that all happen. Yep. And if we've learned anything from this last year, patience is certainly a virtue, and it may not happen as soon as we think. But at the same time, and whether that's lowering interest rates or with the distress that's going to be coming, that borrowers are feeling, we don't know that it's going to be next month or the next couple of months. Yeah. So yeah, we have to really be patient, but also one or two pieces of data or events could completely change the outcome to the upside or downside.
Yeah.
And that's what we've seen repeatedly.
That's what is making this month pretty exciting for me, rather than just like a coast to the end of the year, is that so many things are in flux, but there has been a slow trickle. The trickle of information that we have been getting suggests that a lot of these cycles that started really middle of 2022 are starting to come around, whether it's from high interest rates back to maybe the beginning of a low interest rates, or more importantly, the kind of debt decisions and financing decisions that were made in commercial real estate. They're gonna, I don't want to say meet your maker, but like
at some point, yeah.
The chickens are coming home to roost, I guess.
Yeah, in many cases they are. In many cases, I mean, there's still a lot of hope out there, because I'm just going to pull up the the forward curve provided by Chatham Financial, and looking at where markets are pricing in the rates, where the Fed funds rates and other key interest rates, including the 10-year Treasury, the Fed median, and then also looking at the Fed dot plot. So where those Federal Reserve Board of Governors think that the Fed funds rate is going to be. And I mean, it's really clear just looking at the forward curve, which, by the way, the forward curve has been incorrect every single time. So, but the forward curve did say it's more directionally. So back in 2021, the forward curve was going up. Now it didn't say exactly when or exactly the level, but it was correct that it was going to go up. And I mean, we see that we're basically at the top. This is look at this little slide. My 7-year-old and 5-year-old be like, okay, this is a slide. We're at the top of it.
Yeah.
And we're about to bumpity bump down here. Right now, Fed funds, 5.25 up to 5.35. But, according to the forward curve, again, it's almost always wrong. We're going to be sliding down, and by 2025, basically, let's go ahead 2 years. That's too far. But by December, a year from now, December 2024, there's going to be meaningful decline in rates, with SOFR coming down to kind of a 4.25 handle, 10-year Treasury, basically down to 4%, and then kind of bottoming out is what they're saying. Again, they're almost always wrong. But by 2026, SOFR is going to be 3.5, 10 years, 4%, almost useless is what telling it, the specifics, other than the direction. Because again, if we have a recession, which, is not a certainty. Well, no, sorry, Matt. No, a recession is an absolute certainty. Just when that recession is going to take place, we don't know. Yeah. But a recession is not a crazy thing to predict or to anticipate for next year, with all of just everything that underpinning the economy right now. All this, that has to mature. I anticipate some issues with just the financial system and banking in general. A recession, those rates go lower very quickly. Yeah, but we can't anticipate that.
Yeah, and
we don't know.
I know that we're still in the world of good is bad and bad is good, and more economic activity is inflationary. So we got to bet against it. But a recession next year will cause not only short-term pain, but may push people that were hoping on recession to lower rates. Mm-hmm. Those people will be hurt maybe too much to survive and realize those lower rates.
Yeah, well, because we were talking, if that's the case, there's typically a liquidity crisis, and all of a sudden those extensions and kicking the can down the road for many borrowers who have a loan coming due. That right now banks are saying, we don't want you to get we don't want to take the deal back from you. Yeah. We'd rather you keep managing it, and let's extend another 6 months. Let's keep this going because rates are going to come down. Mm-hmm. There's an actual liquidity crisis or crunch or some real bank failures and some kind of cascading effect, which I don't necessarily think it's going to happen, but it's on the board. Mm. It's going to be harder to give an extension. It's going to be out of those folks' hands, unfortunately. Let's talk about CPI, Matt. You mentioned inflation. We're talking about interest rates. So, it seems appropriate. 3.1 year over year on all items, Matt.
Yeah. So, I don't know how much information we're able to give, and we can edit this out. But we are recording this in the late morning on the same, really hours away from the Fed's announcement of whether they're going to raise interest rates.
They're not going to raise it.
Decrease them or keep them the same. They're going to keep them the same.
As you said, Matt, this is like I hope they do something other than keep them the same, because like we're almost like, we don't even need to watch. We're going to watch, but they're not doing anything.
They're
in
not.
December. Christmas gift.
Yeah. Well,
or could they have a Christmas gift of lowering rates? You think so?
That would be
like a Christmas miracle?
Oh man,
to Joe Biden?
That would drive the markets crazy. Because here's what I want to say.
It's not going to happen.
It's not going to happen. And because this is what I was writing in my notes, is like in other months, like the minute that Jay Powell even indicated that that it may be a scant possibility that rates would go down, the markets went crazy. Mm-hmm. And job growth has been decent,
stronger than people were anticipating on last Friday.
And inflation, especially kind of core inflation, as we see in the CPI report, it's not down low enough for people to be comfortable.
It's not, but if you take housing out of inflation, we actually are like right at 2%. I saw a really interesting analysis by Jay Parsons, and if housing, which makes up 30%, I mean, it has been frustratingly sticky. We've talked about that. I wouldn't say absolutely correctly, but we got the timing wrong, which
we did.
We're bad at timing. Like looking at rent, the rent component and shelter component of CPI is such a lagging indicator, and so we can look at the market rents and kind of back into the lag and see that, okay, well, we know rents have declined over the last year, but with CPI shelter rents still increasing, we know that there's a lag and they'll start coming down. They have, but it's way slower than it happened like in reality.
Usually it's like a year lag between the rent growth that we see, that we track on like private rent trackers, and then the CPI rent report.
But like the way, I'm not an economist enough to say that like the way that they measure shelter and CPI and rent is like 100% wrong, because there's a little bit of like, okay, well, maybe there's some nuance that I'm just not read into. My gut is that it's like not the best though, because one thing I learned recently, Matt, is that they're not even using like the same store data. They're doing a survey every 6 months on different
re-randomized every time.
Yeah, so it's not same store like data.
Oh wow. Okay.
So now it should be, technically, statistical, sample size large enough should I give you, similar results. But so it's just that what are the numbers we're looking at? What is those components? And that's why we like looking at this in the detail every month and taking that out. And so on one hand, the Federal Reserve has made an incredible amount of progress, with fighting inflation, even though they caused it, but on the headline inflation number, it's like we're not all the way there. Yeah. But if we still know shelter is going to be coming down, or it should.
Well, and that's the thing. It's like such a foregone conclusion that shelter, it is.
We know, because the rent's been lower nationally year over year.
Yeah.
For over a year now.
That being said, it is strange to me, and I was surprised that rent of primary residence has been 0.5% increases for the past 3 months. So September, it went up 0.5 from August, and then October it went up 0.5, and then November it went up 0.5. You extend that out all 12 months, and then you get about 6% inflation, which we're 6.5% year over year inflation for rent of primary residence. No, I'm sorry, it's 6.9% year over year inflation for rent of primary residence, and it is a lot stickier than I thought it would be. And
like, at what point do we say it's wrong?
Yeah. That's and
is that like, what are we looking at here, Matt? Is like that does not represent what has happened in the market from every data source we've looked at. What are they doing?
At least it is not rising as sharply as it was.
Yeah, but it should be going down.
Yeah, I know. It should be going down. You're right. It should be there. It could easily be, if it bears any relationship to the trackers that we're tracking, should be negative at some point. We're approaching negative year-over-year inflation for a lot of the rent trackers, and some of them, like Apartment List, does have negative rent growth, and other ones are very near or at negative. I don't think we're going to get far away from zero, but that's the direction that rent a primary. And the other question that I have maybe is if this has anything to do with affordable housing that may not be captured by the rents that are recorded by places like CoStar, Apartment List, Redfin, etc.
But where does so maybe Matt.
Yeah.
Let's say I'll give you the point, but where are we capturing? But not the majority of rental housing in the United States is not affordable and subsidized.
Yeah.
And I should know the percentage of market rate versus affordable, but it's not 50-50. Mm-hmm. It's 80-20 market rate to affordable, something like that, or less on the affordable side. It's not the majority. I mean, it's sizable enough, and it's worth talking about and mentioning. But where does the actual performance of the rents that so many Americans are paying on a day-to-day basis, where does that show up? And if it's a third of GDP or a third of CPI,
to return for sure,
such a big part of the economy, where is that being captured? And again, it's a third of the metric that we're using to gauge inflation, that the market's using to make investments in the Federal Reserve, and they're looking at PCE. I know maybe more than CPI, but they're looking at CPI. And I know they're nuanced enough because they've talked about it. They are very well aware of some of the actual market forces. But at the end of the day, the headline and what you're hearing people talk about is, well, inflation's still at 3%. But is it really if the one metric that is driving that higher, it doesn't line up with the reality?
Well, it may. I think maybe the real thing that we need to talk about is market price. For new leases versus renewals, because because that's another thing is that people are feeling like it's a recession, or they're feeling like the economy's bad, even as they're spending.
Yeah, agreed. But CPI, there's plenty of surveys and of sentiment, and which are good to look at. But we should have some empirical data at some point, and the CPI is supposed to just be well, what is the actual price growth?
Yeah, I think that there really should be and I don't know how they would factor that in and use it in conjunction with the rent calculation that they have right now, but it is an important other way of looking at things, especially if we're trying to plot for future action. It's always the Fed's always going to lag a little bit behind CPI anyways.
Let me ask you this, Matt. We can go into conspiracy corner for a minute, but and again, I like talking about conspiracies. I don't really believe in too many of them, just because it's it's wishful thinking. I feel like I'm oh man, I wish that'd be cool, but it's not the case. But if I was the Fed, but I'm imagining this world where the Fed wants to bring down inflation, but they need to keep rates higher to really make sure that things are tamping down. But if inflation CPI was printing at 2%, there'd be all this political and market pressure for them to start bringing down rates. But if they're not at their target, they're no, we have to stay pat. And so if we can engineer a CPI that is closer to 3%, it gives them the cover to say, we believe that we are now at, appropriate level of monetary tightening, but, we need to make sure that we still see levels come down, especially, and you don't even have to talk about shelter much, but we need to see it come down closer to 2%, which is our target, and maybe even below our target to actually get that kind of average of 2% growth.
Yeah.
But it's shelter is still up so much. We can't, there's nothing we can do. Our hands are tied. It gives them the appropriate cover. I don't think that they would know how to manipulate the numbers.
No. This is what I was imagining. Some young worker at the bureau, some intern at BLS is like, "Hey, we got your shelter inflation numbers coming. It looks pretty low." And then, let's say Jay Powell reads it, or someone else is like, "No, it doesn't."
Not the way I'm reading it.
Yeah. Right, it's a big X through.
So we can walk away from conspiracy corp. It's again, I don't think that's the case, because I don't think anyone's but at the same time, it doesn't make a lot of sense. We're going to keep watching it, and the bottom line is. So go ahead, Matt.
But it does create this picture, if we're just looking at core inflation, of still high inflation, and I was looking at how it's inflation has been over history, and it was 4% now, and it was 4% on its way up to 8. Core inflation was in like 2022 or something.
Yeah,
and then before that, it was all the way in 1992. That was the last time core inflation was at 4.
Yeah.
So it is unusually high. And still, and I think a lot is going to hinge on really like the inevitability of rent going down. But it's just interesting how, as much as, and I think some of the political discussion of inflation going away, it does have a political, it is politically motivated. Like, I'm sure that proponents of the Biden administration want that inflation to be down.
I've seen so many moves in the last week or two of positioning from the Biden administration, for the election, whether it's like, I mean, it's all started with, student loan, forgiveness. Like that's an election play. There's a big announcement on new railway studies and projects. That may or may not ever happen. Like it gets people, it's getting the base excited because the base likes trains, which I like trains too.
Trains.
But like, you just have to say that we're like studying the trains. You don't have to actually make any trains. And then, again, they announced some tighter border policies because, obviously they're going to be getting hit really hard. And not to get into politics, but long story short is there are a lot of the economy is the biggest play in the outcome of an election. It's not going to be all the ancillary stuff unless something really kind of boils up. It's, how are you going to be doing? What are your personal finances like? Are you in a better place now than you were a couple of years ago?
Yeah.
And, there's all, but it doesn't mean like, are you actually doing better? It's, that's when it comes into the, how do you feel you're doing? And people feel, even though maybe rents have gone down, they don't feel that. They feel like rents are really expensive because they are 20, 30% more expensive than they were a couple of years ago. Haven't gotten used to it just because like the market rent has decreased 2% from last year. Okay, well, it's still like $300 more than it was a couple of years ago. So I don't, I don't really feel it. Political parties see that really every re-election is an existential threat. Every election is the most important presidential election in our lifetime. And it's so just every time. It's the most important every time. And so it can't be. No time. But what would you be willing to do to win? And I think the Democrats and Republicans would do anything to win, because the other side is an existential threat to democracy or freedom or their way of life or whatever. And so I'm not even talking about like the shady stuff that whatever has been going on since the beginning of time and whatever types of political system you have. But if you can position yourself to be able to have talking points, and so but it has to start showing up somewhere in the economy. And so, and again, it just has to be the narrative. The Federal Reserve knows a PSYOP. The way they communicate is the most effective form of monetary policy. They don't have to lower rates. They have to just talk about. They don't have to talk about. They don't have to mention.
Exactly.
They just have to talk about. We are moving towards a neutral stance of monetary policy. They don't have to say loosening. We're just moving towards neutral, away from tightening. And some other coded words.
People are gonna freak out and party
because they'll party, and they'll continue to buy treasuries because they think that the rates are going to come down, and they'll be able to see some appreciation on those bonds, and eventually that will bring the long-term rates down, and then the Fed funds rates can be. So the Fed doesn't have to lower the Fed funds rate; they just have to talk about it, and the market will price a lot of it in, and that will be, in effect, doing the same thing. And so, and again, I don't like talking about politics when we're supposed to be talking about multifamily housing, but since we're talking about how's the multifamily market is absolutely the reason why it's going through challenges right now. Two reasons, but like one of the main, the taking the supply and what's being delivered right now, because we could get through that if it wasn't for the way these deals were financed. And that's really the real challenge. And it's directly related to debt and interest rates. And rates being significantly lower halfway through the next year, early next year, or same or higher, absolutely is going to be, a paradigm shift one way or the other on how multifamily investors behave and
the
react.
Political consideration and that, November 2nd election deadline is it's interesting to think of as a factor of Fed decision. So are they going, yes, they are stewards of the economy, but, just as a thought experiment, if they do truly, like they're not supposed to, serve the administration, then when would be the best time for them to cut rates? They don't want to cut it too soon. That might bring inflation. But when is the maximum amount of, good vibes that you can generate?
Well, and then the fact that, and again, it's like the Federal Reserve is supposed to be completely independent from the administration and the government. They're not even, they're a private organization. But, wink, wink. There's some conversation, but Jerome Powell, was anything, more of a Republican and conservative, but also he's head of the Federal Reserve. So it's going to be really fascinating. Matt, one more just on the political front. Just I don't see it in here. I don't know. Maybe we're going to talk about it last week, and so I apologize. We're just talking on the fly. Did you see the whole thing about the bill that was introduced? I want to say it was in the Senate. It sounds more like a House bill. On regulating hedge fund ownership into real estate in specifically single family homes.
I heard something about that, but I think that I just dismissed it outright as an absurdity.
It is. It is an absurdity. So maybe we'll talk about it on next week, but it could be another part of that. Again, that's not going anywhere because just the notion, the premise is incorrect.
Fat cats buying your homes.
Yeah, but
we talked about that 3 years ago.
But it's not the case. And actually, the YouTube channel, the Plain Bagel, which I know you watch sometimes, did actually really good at kind of expose on it. I think very recently. And kind of just headed it off, just some of the idiocy of starting with, it's everyone's saying BlackRock is buying up your home. BlackRock's buying up your home. It's first off, you're talking about the wrong company. It's not BlackRock that's buying any real estate at all. Blackstone, a different company, is the one that buys real estate, and they don't really even buy single family homes. They buy apartments. And the top 10 or top 8 single family owners, it's not Blackstone, it's not BlackRock. You're talking about other companies. And so and then if you actually get into the percentages of ownership, it's, it's in the fractions of a percent. So anyway, it's a bad premise, but it's all virtue signaling and preparing for an election.
It's a juicy narrative that you can put yourself in as a homeowner or as someone that's trying to buy a home, which is almost everyone.
Well, so that's the thing. People are frustrated because prices are expensive. And they're looking for someone to blame. Don't blame the Federal Reserve that brought interest rates to zero and allowed everyone to run in and pay crazy prices because the money was free. No, blame,
Don't blame your neighbor that's not selling their house because they don't want to get a new loan.
But instead, let's blame hedge funds, which are hedge funds good and pure? Definitely not.
They're not raising the housing prices. They're going in after rents go up. They're buying at lower prices than people would buy normally.
The argument was that they're going in and paying whatever and paying high prices.
But that's not all I know is when we did talk about this, it was a couple of years ago, the hedge funds, large investment groups are unwilling to buy at the prices that an individual home buyer will buy. It just doesn't make financial sense to them. And we talked, I think rightly so, there is this emotional, psychological component of, and they're willing to bid it up a little bit more.
Well, that's it for politics today. And and probably on CPI and inflation, although that's going to be another perennial topic that we'll be continuing to talk about, but it's certainly driving the market and industry. Matt, let's get into some of these outlooks. We got one from Colliers, one from Cushman and Wakefield. Really exciting. Now we're going to be talking about our own 2024 predictions and outlooks next week. We've got some really juicy takes. Really it's this stuff is ripe.
I do. And this is part of what makes this December particularly exciting. Really, every December is that you get these forecasts, and this December, it's interesting how much of a change it's going to be in 2024, and how much I think that there's room for some opportunity. Rather than in 2022, it seemed all right, let's brace ourselves. In 2024, 2024, there's going to be some interesting changes.
Yeah. Well, there's a long period of time because the market was good. I remember asking myself, are these, people who put these reports out, would they ever say anything bad about, the industry?
Yeah.
Because it's like, there's self-interest there. And, are they ever going to say, 2024, 2025 is going to be a rough year? Because there's always like, 2017, it's like, all off to the races for multifamily. Nothing could, get in this asset class's way. Like, never made more sense ever. And, but the outlooks are less rosy from like valuations and, prices and like talking about distress. But the fundamentals, which is really what should be what is focused on, are a little brighter in many, not all cases, at least talking at the long term.
Yeah. Now, Colliers does start off with some economic notes, but I wanted to zip into the multifamily side really quickly.
Yeah,
and they specifically note like some quick things that you should follow, and they start right out with development concentration. Not just so 2023, I think the big story was supply, but in 2024, it's still supply, but they rightly note how local the supply is going to be. Specifically, they say that markets with tremendous population growth over recent years have received a new wave of development, causing fundamentals to soften. Understanding development concentration risk and further deterioration is important. The idea, that last line, understanding development concentration risk and further potential deterioration is important. That's powerful stuff for as kind of boring and technical as it sounds. It's like they are built, all these Sunbelt places, their population may be grown hand over fist, but they have overbuilt that. And so it's like, you got to look past that shiny, exciting market because like all those cranes that you see in there, like that's probably going to affect performance at least in the short term.
Yeah. Well, I was going to say, so it cuts both ways, right? So you have to look past the population growth, but also in many cases, you kind of need to look past the cranes and the supply.
Yeah.
If you have a long-term outlook and prospect investment horizon, if it's short-term as in like 24 months, 24 months is cutting it pretty close. I don't know.
Yeah.
Maybe. But again, like, the real upswing, you may miss out a lot and you just don't know. It could take longer. It could take shorter. But I'm, again, not even a big investor in the Sun Belt. It'll get absorbed and it'll do well at some point, but it's not going to be tomorrow. And it's really more troublesome, not for buyers today, but the buyers of the last couple of years who had very strong growth assumptions, which allowed them to pay incredibly high prices and were paying peak, absolutely, bottomed out cap rates, top of the market. Cap rates in the 3s, even some in the 2s, the levels that I don't think that we're going to get back to for a long time and maybe ever. I think that if we were back in the, kind of 5 cap range, that might seem kind of normal and very reasonable to people. But to say that we're going to go back down to the 4 cap range, maybe on some incredible assets and absolutely incredible locations, but I certainly wouldn't want to be that. I wouldn't want to be counting on that for my business plan.
Yeah. No, I agree. I think that I think that it still is interesting to think about this in terms of an opportunity as well. So avoid the places maybe, but also look at the places maybe where there's not construction. Now this is kind of obvious, but like there may be a place that doesn't have a lot of population growth, but it also has very few apartments coming online, and that's a place for a real opportunity where you can kind of come in there. So obviously moderate with both of those as a factor. But in addition to the supply concerns, the report also notes high operating expenses, low housing affordability, and curtailed capital flows. Now, those first two, expenses and affordability, were a big thing in 2023, and I think it's worth noting that Colliers expects this to continue in 2024. The survive until 25 has never been, more apt here, and it's really going to be a matter of survival in navigating these expenses. And the low housing affordability implies a little bit that there's going to be resistance to rent increases. Now that's going to be an interesting development to see, because it also kind of references the fact that it's hard to buy a home. So I think that we are getting to a point, hopefully, where there is room for additional demand and additional rent growth. I think that we've been through a whole lot of supply increases, and maybe part of the reason why CPI rent growth has stayed so stubbornly high is that the demand is still there. It had its year to sink.
Well, we've talked about that before, Matt. Is that even with the absolute deluge of new supply coming online, things are soft, but they're actually not nearly as soft or as weak as they could be.
Yeah.
And you could look at it as like surprisingly resilient in the face of unprecedented supply. I mean, rents being down 8%, while it really screws up your pro forma. It's again, it only messes you up if you needed 10%, and you bought the year before, and then you got one. If you bought years ago, you never were anticipating double-digit growth, and you're fine.
Yeah.
So, or if you just have any kind of short-term time horizon, that's when you've been cut. You need to either you're gonna have to sell it for just to get your money back, or you're just gonna have to turn it into a long-term hold.
Yeah,
simple as that.
Yeah, I agree. That's really all that I had to cover from this short Collier's report.
This moves.
But there's other. Okay. So I did want to note this difference between the Colliers. Now I'm a big fan of the traditional PDF. It's a little simpler. It's a little more, but it's a little.
Do we have the processing power to operate this?
I am not sure, but I did note, even in my notes, I said
this is a PDF, Matt. What kind of Adobe technology?
It's not a PDF.
It's HTML.
It is some kind of
a website.
Yeah, some kind of like Flash. I don't think it's Flash, but really, just navigating this takes a couple of clicks, and you have to go through some animation. Call me a simple man, but I'm okay with scrolling through. I don't have to click on like your little arrows to make sure I access all the parts.
What does this mean? Is this the commercial real estate matrix? Even though we would go custom cursor. This is nice, Cushman.
So it's immersive.
Wow, this is great, Cushman. You guys, I don't think your stock price is doing that well. You've got a lot of debt. Love you, but I don't know. If this
another
is
article. I don't know.
Anyway, is the data?
So going to the data, their headline take is that we are in what, as it pertains to the economy, they say that we are.
Do this Figma.
It could be Figma. I don't know. some Adobe kind of thing. We are in what equates to a rolling recession, and I think that's an apt point. I think that may be more applicable to 2024, but employment never really took a big hit this past year, so it's hard to see. And technically, it's 2 quarters of negative GDP or something along those lines. But I don't know what committee meets and calls things a recession or not. It is really it's beyond me.
Oh, there's a poll.
But they do have several. So in order of good. We can all vote on it, and then we'll find out if we are or not based on how we feel. Regardless,
I don't like answering this question. Yes.
Yeah.
Yes. No. And we're not in a recession now. I don't believe that.
There are people that certainly feel it, and that's why maybe we're the.
Can I just abstain?
Yeah.
I'm going to just speak. I'm just going to take. I'm going to kind of punt, or I'm gonna audible over to their piece and the Globe Street piece, and call for H2 2024.
All right, sweet.
So it's like an answer not answer. What are the results?
Oh,
H1. Everyone says that we're in a recession now. You think that's the case? No. What are we defining as? I mean, two negative quarters of GDP.
Yeah.
So is there any evidence that we're? No. I mean, manufacturing has sort of been in a recession, maybe coming out of it. Some things have been slowing down, but at the same time, job market's been steadily cruising along. CPI is still up, so I don't see that we're having. I mean, we had 2 negative quarters of GDP growth that didn't count.
Yeah, I remember that. We talked about how I guess the recession was in our hearts all along. But I think that this is a product of economic sentiment, and like I kind of mentioned to Addison last week, like the lingering effects of inflation are weighing down on people, and maybe are coloring people's opinion on whether it's a recession or not. It feels bad when your dollar doesn't go as far. I do think that aside from predictions of recession, this Cushman and Wakefield report does point to several factors and that are very convincingly indicating a downturn. Call it what you want. It's not all rosy. It's not a rosy picture completely for 2024. But I think that once you look at these negative factors for the economy, then you can kind of navigate them a little bit more, and it gets a little bit less scary. But putting things in context, they talk about rising delinquency rates on auto loans, credit cards, mortgage loans. They talk about a protracted yield curve inversion. We're going on I don't know, a year plus.
Yeah, I think we're approaching the kind of the 18-month itch.
Yeah.
So it's, if it
should
be getting close.
So that's another indicator, a slowdown in temporary jobs, which usually precedes other,
it's also, it's like not a lot of law of like physics or anything. They're like 12 to 18 months after the yield curve inverts, it's when the recession takes place.
And it is variable. They did note that too. So it's not like a full law, but it is probably expected. That's hard to imagine it not being.
I think it's like 7 out of 10 over the last century.
Yeah.
So, and even like in the 90s where there's like the one soft landing was like achieved is what they're saying. Yeah. Even then there was a lot of economic slowdown. And it was like pretty much close to a recession. Like I remember. I was pretty young in those days, but like I remember people talking about things not going great in the early 90s.
Yeah, and even now, like as much as there's political arguments back and forth, like it doesn't feel perfectly great, and everyone knows it.
Yeah, like so if let's say there's no recession in 10 years from now, would people be like, well, actually, everything was all good back in 2023, 2022, 2023? We'd be like, I mean,
yeah.
But I don't know. Maybe if everything turns around and all of a sudden it's like, wow, these deals like just make sense and great opportunities. I don't know. We would have a different opinion because we do have recency bias and like immediacy bias.
Yeah. But kind of continuing that. So there's that slow payroll growth, expectations of job losses due to falling construction activity in 2024 as these projects are kind of winding down. So again, there's reasons why. There are multiple detailed reasons, complex reasons why we may be headed for a recession, but I think that it all boils down to a simple reason, which is interest rates. Yeah. Like that all kind of follows from that one logical thing.
Price of money. Yeah. Price of capital. And again, that's where the Inflation Reduction Act, which is really the infrastructure and, optional inflation bill. There's a lot of spending in there that could kind of buoy things, spending and like some of those construction jobs, the infrastructure bill that was passed.
They're kind of getting started.
Yeah, a lot of those projects. I mean, some of those projects are going on right now, but those projects, there's still projects in the pipeline. Okay. And it was making labor pretty competitive, adding to inflation. It was supposed to reduce it. But really bad name. But I'm just, again, going back to the political influence, just looking at where construction is going to slow down, that could be an area where the government can step in if there's already these projects that have been,
lots of juicy projects in
probably not enough
purple states.
Probably yeah.
Some swing state.
Everyone wants some of that. those the stimmies.
Got the really really nice bridges and infrastructure in every swing state this coming year.
Yeah, exactly. The stimmy economy. The largest companies, there's always used to the stimmies. They've gotten the stimmies forever. It was just the folks that were at and below the poverty line all of a sudden got some money, and that was horrible.
Now we notice it.
Everyone was paying their rent back then. I do know that.
Yeah, true.
Maybe no one was working. That's a problem.
I don't know.
No free lunch. Anyway,
when it comes, I want to jump to multifamily specific stuff because they do have a sunnier. They do have a sunnier disposition on the multifamily market than maybe Collier's or a little bit of these other forecasts that we've been describing, in this report alone. They say strength is on the other side of the supply wave, right at the top here, and the quote is that, if you're looking at vacancy rates alone, which steadily increased from an all-time low of 5% in 2021 to 7.8% as of Q3 2023, it would be suggestive of deteriorating market conditions, but it actually masks favorable demand side trends that have reemerged this year. So they lead with this explanation of apartment demand as a snapback from that huge demand that we used to see, but that's true. But it is also supply is such a big deal, and ultimately they do think that even though the supply has been big, even though we are in the wake of, the 2021 rent bonanza, that there is a lot of strength behind it. And it just for another quote here, they say the supply wave is a near-term phenomenon, and we are currently at or very near the peak. New supply is expected to crest in early 2024, and we are forecasting 400,000 new units to come online next year in total. That's less than
400,000.
Yeah, that's less than some other estimates. But after that, they say supply is set to slow abruptly, settling into an average of 183 units delivered per year from 2025 to 2027, which is 25% below the 2015 to 2019 average. And, they're noting that the starts are down 60%, and that's some real numbers. And I appreciate that they're able to put kind of their money where their mouth is.
It's almost 2026-ish is when we'll maybe all the economy and the multifamily market might actually see some equilibrium.
Yeah.
Which is crazy to think that it's going to be, half a decade post COVID, beginning of COVID, for us to kind of get back to it.
Yeah.
Which obviously it's more than COVID. A lot of other things have happened, but and it could take longer than that. That's where I hate to even. It's not what anyone wants to hear, or what I want to hear or think, but I do have this gut feeling that things are just going to take longer than we want them to, and longer than they normally would take. And we talked about it a couple of weeks ago, and to me, it's time was compressed. We had multiple years of growth within a single, you'd call a year and a half. And I just think of, in physics, when things contract, they typically refract afterwards. You compress and decompress, compress and decompress, whether it's waves. And so if we're in a period of decompression and refraction in time sped up, that would then be spread out over a longer period of time. And so our normal expectations of how long something should take is we're not in the same space-time anymore, to lack of a better term, because it never made sense that we had 30% rent growth in a year. That makes no sense. That's 10 times normal. Yeah. So, if we're now the inverse of that, instead of multiplying by 10, we're dividing by 10, that could spread out over a longer period of time. And I hope I'm being hyperbolic and just connecting dots that shouldn't be connected. But I think the same reason why everyone was certain we were going to have a recession at the end of last year, or immediately in the beginning of this year, it just never happened. I could just see things taking longer than we really want, and that itself is an existential crisis to a lot of people, because they don't have the time. Time's money, and those rates aren't going to come down as quickly, or things aren't going to turn over as quickly, especially in real estate, which is so slow moving. I mean, we want it now, tomorrow. I mean, we're in the economy of I can get everything on tip of my finger, listen to any song, watch anything. Yeah, we want the interest rates should be lower.
Yeah, that's interesting.
Back to normal.
Because I wrote right underneath my little notes for that passage I read. That's survive till 25 spirit, but
but what if it's just survive till 27?
I know that's
exactly. 25 people are I can make it, but if it's 27, that's tough. I mean, do you have enough food and water to get a crop? I mean, to make it.
Yeah, I wonder how. So you're saying maybe we can't even use pre-pandemic trajectories.
No.
As a yardstick.
I don't think so.
Because it's gonna be so much different. I wonder if there's going to be
still
some
dealing with the
reverse.
I think we're dealing with the same. We're still dealing with the initial shockwave that COVID and the injection of money, the expansion of the money supply, and the government action was so unprecedented and so extreme that we're going to be dealing with it. Now, you could say it's going to be like, in a World War II, and that's going to eventually just lead to economic activity, allow us to recover quicker. And maybe that's why we haven't, seen a recession. And we've never been here. So it's not like, oh, I know there's going to be a recession. And that's going to be drug out. We're going to be dealing with the effects for, a longer period of time. And I think if we look at it in more the form of like cycles and waves and things being compressed and then expanded again. Yeah. Which in my observations as a non-physicist or economist. Yeah. But again, play economists on I practice economics in our business and manage over $750 million worth of assets.
And that's better than a lot of people that do call themselves economists.
Yeah. I don't know. I don't know about that, but I don't know, Matt. We have to just be humble. Like we don't know, but the things that we want also influence our perception of things. And I want the rates to be lower in a buying environment tomorrow for a lot of reasons. Acquisitions are the driver of growth in our business and our company. Yeah. Like it's really hard to grow in a meaningful way just by, just managing your current assets, which, it's been a great opportunity to not do any acquisitions for a while and just to just operate the hell out of our deals because we've been crushing, we're going to be in a better position because of that. Not that everything is always smooth sailing by any means. But it's like, man, we want to keep growing. We want to keep doing some more deals, buying some great real estate, or earning great returns for our partners and investors. But if it's an environment where that doesn't facilitate that, not that there aren't others buying it, because again, in their mind, that's not an option. Yeah, it's growth at all costs. And the investors, they'll figure it out in a couple of years if the returns aren't that good. There's been a lot of that going on in the last. That's 2 years.
Something that didn't come up in a report. Maybe we'll talk about it next week, but that's been on my mind for the past 2 weeks, and really this week.
How would you know?
Is like if you're an how would you know that yeah, exactly.
You get distributions. Well, a lot of those funds were raised. The distributions were raised as excess capital, which lowers returns. But again, you're not going to really see that until the end.
So to clarify, this is just like, what if you were an investor in a multifamily deal that is going bad? There could be a chance where they're not telling you that it's going bad.
There's multiple public examples that have been unfolding very recently of where, the June update was everything's great, nothing to worry about. And then the next update was capital call. Sorry, everything is, we're in a horrible situation. There's multiple of those examples that have happened very recently.
Now, I do think at least the articles that I read, it seems like the sponsors of these deals that are able to negotiate with the banks are the same ones that are also communicating with their investors. Yeah. It's maybe the ones that lack sophistication that they're unable to get a deal with the banks, but they're also unable to really communicate effectively with their investors and tell them that something is going wrong. It goes both ways.
Yeah, I think it does. And sometimes, in a lot of these cases, it's not even like they're not communicating with their bank. In some cases they're not, but sometimes it's like they don't know how to negotiate with their bank, and they don't know
that it's possible.
No, I remember doing a couple deals early on as a co-GP, and talking to some just my own advisors, and it's going to help guarantee a loan, and they were like, well, what kind of terms did you negotiate? And I was like, well, I didn't actually do the negotiation. Our partner did that. Let me talk to them. And I'm like, hey guys, tell me about how this was negotiated. And they're like, well, just like what the bank gave us. This is like their deal. So we didn't negotiate. I'm like, no, you can negotiate with the bank. Yeah. And they're like, well, I mean, we could, but it's like, they're good. And no. Yeah. No.
That is
this, no. They're going to push back. Yeah. That's not how it works. Yeah. You can go to the other, but you go bank down the street, 15 banks, and obviously some are great, and there's relationships and all of that, which is incredibly valuable. But even with those folks, it's like you got at the end of the day, it's like let's get the best terms possible. And so if you're in a bad situation, if the bank's coming in, you're like, I don't know what to do. I've never been in this situation before, and the bank comes to you and they're like, this is what we're going to do. Apparently a lot of groups are like, okay,
Well, because they don't know the alternative.
They don't know the alternative, and I think a lot of them just want to be done with it. They've had probably a year of where they've known things aren't going great, maybe 6 months, year, and they want to be done with it. They want to be able to like move on to the next deal or the next industry, the next business. Just like this deal, I want to be over and done with. And they're just throwing in the towel. And the ones that are suffering are the LPs who are losing their money, because there have been multiple instances just that I know personally, people who are in other people's deals that have that equity's gone to zero.
And that's what I was talking to Addison about last week. It's like, okay, so let's say you are, sponsor X, and sponsor X, they have a bad deal and they lose a bunch of LPs. Are they going to get like? They can probably go out and get other investors.
There's people who have
tattle.
There's not many people. Some people do, some people don't. I mean, there's groups right now that have had to issue capital calls because they overpaid. Yeah, and then they're raising more funds to from new investors to bail out their deals.
And I will tell you my experience, my perspective, and repeat a little bit of.
And they're also like telling people like how to do things and coaching people.
And I feel the same emotion spilling out from what I said last week with us. It's like, no, these investors are precious to us. I spent a lot of work getting them. I don't want to ruin their, and like the priority that we place on communicating with investors, making sure they know about everything, and the work that goes in to cultivating this relationship is way more important, and it's flabbergasting that it seems like some people are throwing it away.
This might be like a bad way to look at it, and it's not the only way I look at it, but to me, it's almost like a game. And for me, the objective is not like the points on the board, which is like the money you make. Like that's a component, but to me, like the objective of the game has really nothing to do with like the points. Like you can use the points in the game, but the objective is to like do good deals and to like achieve objectives. And the achieving objectives are fulfilling your, that you're not promising, but, fulfilling what you said you're going to do to your partners and investors, and hitting your returns and exceeding your returns and doing good deals and doing good by your residents, doing good by your investors, doing good by employees, and just producing like quality work. Like that's how that's how my game is won, is we're achieving like those objectives. And typically by achieving those objectives, like the points over here, like those are going to go up and you're going to have a decent amount of points. But like you don't win the game by getting the most points. You win this is my game. Anyone can create your own construct of whatever game you want. But like my game is, can we achieve these like discrete like objectives? This deal does really well. It outperforms. Residents are happy. We've made a better place for people to live. We've improved people's lives by creating a better living experience, better community, which is way easier said than done. I can say it all day long, but like the practicality is, some residents don't want to work with you. It can be challenging. I want to just crush it for investors. I want to make them a lot of money. And that's a win. And if I do those two things, the points are going to go up. So some people are just thinking about, I don't know, the points, and like the objective like doesn't matter at all. They're quitting the game, and
they got all their money. They don't really care. They have different goals.
I guess it does.
It does. So. It does seem like, and this is a real test. This next year and this past year has been about like, okay, what's the best way to run a business? And some of these people that I kind of have to keep churning maybe are there. It's going to be hard for them to keep surviving.
And I believe in like generally like the goodness in people. Not that there aren't some bad people out there, but generally I think most people are good, and the people have like good intentions. Even people who I'm like, you're doing horrible things, but I believe you think that you're doing the right thing. I don't think that there's a lot of like syndicators out there that had bad intentions. I think that, but you're being ill prepared. And then unfortunately, it's just like the tale old as time is greed. I mean, it's like to get the deal, we need to do another deal, and only the way to win the deal is to use this, short-term floating rate bridge loan because we're going to be able to close a little bit quicker, and that way we're going to get the acquisition fees. And wow, okay, how do we make the deal work? Because we want to win it. It's all about winning the deal.
They're going for
They're going for the points, and they're like, well, we're going to have to use some really aggressive rent growth. But like, well, that's how fast rent's growing right now. So like, we can just tell people that's realistic, and that's going to keep growing. And also, and again, this is where I don't think that anyone was purposely most were not purposely deceiving, is because in their mind, they've only seen cap rates go down and prices go up.
Yeah.
And so they're like, okay, well, maybe we don't hit the 20, or the 30, but we'll still get, be 15 and things will all go well. But in fact, the 15s we were targeting and turned into 30s. So like in our experience, in the recency bias, like the deals end up working out, and because the tide lifts everybody up. Well, now the opposite has happened. And again, it's a multiplication of factors of, the cap rates are going the wrong direction. The net operating income growth is going the wrong direction. Interest rates are going the wrong direction. And it wasn't what anybody intended, but just at a momentary place in time back in 2021, I think just the greed got to too many people, and the prices got too crazy, because I don't understand anyone justifying their deal they bought at a 3 cap.
I'm surprised, and I wonder if we're going to start hearing about more stories about LPs that have, that have lost all their principal, or LPs that are really angry, rightfully so.
We should have some on.
Going wrong, yeah.
So if you're a limited partner and you'd be willing to share your story, get in touch with the Great Capital team. Leave a comment below, or just email Matt at greatcapitalllc.com.
We always strive. I will say this because it's a subject of pride and a little bit of anxiety. We strive to be in constant communication and and deliver for our investors in that way. And I'm curious to see what the standards are, because we do a lot of work to make sure that that things are looking good on our side.
Yeah. Well, and just to try to keep you up to speed all the time, just a quick plug for the Great Report newsletter. It's the top newsletter in the business. It's the original commercial real estate with focus on multifamily newsletter. You can sign at greatcapitalllc.com/newsletter, or just go straight to greatcap.net. Got a few places you can go.
This is just the Sunday update that you're
this is just the Sunday update. Well, you get twice a week. It's a great report newsletter. greatcapitalllc.com/newsletter. And, if you're going to do that, make sure you subscribe to the YouTube channel as well, so you can make sure you get these videos in your inbox.
Hey, last week I was with Addison. Yeah. I did a couple plugs for the newsletter. I felt so proud of myself. Good. I felt like a real broadcaster.
That's right. So Matt, where would you like to venture? Should we go to distress? Because just to end it, we can just do all of the negative stuff, and then we can move on to maybe some stuff that's just generally more positive. If that
it always seems like there's always more news that we can fit in, and that's fine.
Always, or do we get to drop the AI piece? Oh, we do. Good. Good.
It's always at the tip of my tongue.
Well, I don't like saying we're going to do a piece and then we've run out of time, but that's why I am like, well, there's an AI piece on the docket, but and I'm reading the headline. And I'm like, and we're dropping it.
Yeah.
Not really. There's some truth.
And to tease next week, we that could be part of our discussion if we're going to talk about some major trends that are happening in 24 that we identify.
Oh, it's on the list. It's not as big of a deal as people say it is.
Yeah, that's largely my and
it is, but it isn't. It's not the way you think.
Not
the way you think.
I agree.
Until it is. And
again, I wouldn't ignore, this is all I'm going to say, is I wouldn't ignore the potential, but it ain't there yet.
Exactly. Just completing the next word in the sentence.
I know, it's already making me generate text. Jeez. All right.
Prediction. Multifamily distress will start in the second half of 2024. Given market dynamics, it seems impossible to put off forever. Eric Sherman from Globe Street. laying it down hot and heavy. Matt, is this just some little clickbait? Got my attention, but I think it lines up with a lot of folks are saying, and even lines up with some of the previous reports and reporting that you yourself and myself have done.
Yeah, it's a good hook for a headline. There is some nuance in the in the article, which is any good article. You got a clickbait headline. That's your responsibility to get them in, and then you kind of fudge a little bit in the body. Now, this is an interesting prediction. I think it may make sense more as a forecast for multifamily market values rather than a specific prediction of like distress that characterizes the market. I think that multifamily distress will be a discrete factor that will move things, but it will be, and this is kind of what we were talking about too. It's one of many: apartment supply, low rent growth, and properties that may not be technically distressed, but still may have issues that make it maybe more that make them more amenable to sell at a lower price, for instance, or just any of a number of factors that are we have just spent the last hour talking about.
Distress is a certain. I mean, there is some distress. There's some distress right now. It's just how much distress, and I guess will the second half be peak distress, and will it be systemic distress that affects the entire industry or a large percentage of the industry? So how are you going to define distress? I mean, I would add like a certain percentage of the market that's in default, or certain amount of I think defaults would be certainly a KPI. I would be tracking foreclosures, value decline, but again, private markets are finicky in that way because values may have decreased, but if you're not actually transacting during that decrease, it's the tree that fell in the forest, no one heard, doesn't make a sound.
I think that we could easily have a podcast that only deals with LinkedIn comments from commercial real estate people, because some of the chatter about distress is expected, how much capital is available that is ready to like pounce on this distress. That's been such a big topic and a subject of some kind of arguments. Like some people point to all this dry powder and they're like, oh, that's it. That's gonna like keep all the values up, obviously. Yeah. But then like the counterpoint is like, no, there kind of always has been dry powder for a long time, and they're waiting for like an 18 IRR or something like that, like a really high, really juicy deals that may not come.
Yeah, and that's the level that we probably read the same piece, and it did make sense that most opportunistic buyers would get into the market when they could see returns in the 18% IRR range, which that definitely sounds about right. Which we're just not seeing that. I mean, again, we can't even get to 15, being reasonable.
Yeah, and the other consensus does seem to mean that I've seen some doubt about the power of multifamily distress. I still think it's a slippery term, and that it is worth following as a factor, just not as a crisis in and of itself.
Gets people excited.
Yeah, it's a good headline, and it makes me.
And there is distress, and so, but it's so nuanced and so local, and it's even sub asset class. Are you talking about C, B, or A? Because, there's probably more value declines in the kind of workforce housing C class space, because if you think about those deals, the sub asset class, those demographics. Those cap rates compressed, and there was a convergence of, A, B, and C class kind of cap rates. For beforehand, a C class deal, old vintage, even if it was a value add, it was still going to trade for a 7 cap or so, and you're going to get it at a good price. Where all of a sudden, that upside and the value add started kind of getting priced in, but people were still doing it because you also were getting cap rate compression. But what the result was, the cap rates for value add and kind of stabilized deals were basically the same.
Yeah, that's crazy.
But people were like, well, but no, the value add deal, though, you're going to be able to, and actually the value add deals, cap rates were much lower, because they're like, well, you're going to get all your upside, you get the value add. Well, in a lot of cases, but, I get that. You're not just buying it for how the previous owner operated it. You have a vision and where you can take it, and that has to be factored into the price you can pay. And if you see a different vision than someone else, maybe you can pay more. I think that's the art of real estate investing. But at the same time, to be a good value investor, and the way I learned about investing, to start especially was, You got to buy on actuals, and the way the commercial real estate is valued and prices, the cash flow that's flowing off, like today, and then really last year and today. And so that's shifted, and it's somewhere, in the middle, but those cap rates, when they converge, and now they're expanding again. So now the older deals, the value add deals that no one really wants to do anymore because they're older vintage, they're harder to manage, they can be a headache. Those cap rates are expanding from a much lower point to a much higher point. And so where like the A-class deals, let's say they were down at 4, well, now they're at 6. Well, the value add deals, they were at 4, maybe 3.5, and now they're at 7.
That is going to be
a much wider swing and a much more of a decline relative to kind of B and A class deals.
That is really interesting. And, I don't know if this rhymes at all with the term rolling recession that Cushman Wakefield invoked, but like different parts of the economy, different sectors may swing different ways at different times. And certainly different populations of renters are going to be affected by the economy in different ways.
And that is always taking place, and it's not, and I don't know if rolling recession is right, but just in the last cycle, I mean, there were periods of where workforce housing was just like the place you wanted to be. You had the great rent growth, the value add was there. I mean, it made a lot of sense. You could buy great pricing, and then it got to the point where the kind of core plus made more sense, kind of early 2000s vintage, 90s deals. I mean, it just like the returns were just the same with a lot less risk. And because, not only like value add, what people miss is like to get from point A to point B is not a sure thing.
Yeah.
And now a really good operator with a good track record of doing it can get there pretty efficiently, but there's always like things that happen, some things that are outside of your control. But the reality is there's a lot of groups that didn't really have the experience of managing those large construction projects, and like they didn't get there, and they needed the growth, and maybe they couldn't manage the construction project right, or the costs went up, or the rent growth wasn't there, but all of a sudden you bought a 3 cap to push it, and the goal was to push it to a 6% yield on costs or whatever, but you're still stuck at but then you brought all this money on, so you bought it at a 3 cap, but actually your yield on cost is like 1%. And then cap rates rose, and you've lost all your equity.
Yeah, I think that's a big story. But
we're value add. The value add's great. Value add's great.
Well, and you know what I was thinking about, all these OMs that we get sometimes from brokers, where they put in value add as though it almost has already happened. Like, oh, you can do X, Y, Z.
Day one. I mean, I don't know. I mean, this is crazy. I don't know how many performers I've seen from groups that it's like, oh yeah, day one we'll have renovated 200 units and increased rents to $200, and so we're going to get 10% cash on cash year one.
My joke is that and you're gonna find oil on the property. That's obviously going to happen.
Yep, gold.
Buried treasure.
You're going to find some lithium. Some rare earth metals.
So that's funny.
Yeah. So we shall see, Matt. I mean, an interesting little time period here.
Yeah.
All right. So, anything else, Matt, today, or are we wrapping things up?
I think we should wrap things up. This is there's a lot more to talk about. Stay
Next
tuned.
Week. Yes. Yeah.
And subscribe to the Gray Capital newsletter at www.graycapitalllc.com/newsletter. Any article that I missed that we don't talk about today will be in a newsletter or has already been in a newsletter.
Yeah, that's a good point. Yeah, so make sure you like, subscribe, be on the newsletter, and be on the lookout for the next opportunity from Gray Capital if you're an accredited investor. We've got maybe some distressed opportunities, some preferred equity, earning some really solid returns. Again, I think it's the right move in the market to achieve our objectives, which is to get some wins. So let's do it together. Reach out to us. Love to have a conversation with you. If you don't listen or watch the Grow Report before the end of the year or the holidays, which I don't know why that would be the case, because we're going to have an episode coming out next week, a holiday episode, maybe even a bonus holiday special. Happy New Year, Merry Christmas, Happy Holidays, Happy Hanukkah, Kwanzaa, and Boxing Day is good.
New Year's Eve.
To you and your own. I said New Year's, but New Year's Eve.
Oh, yeah.
But you got New Year's Day, we got New Year's Eve.
That's right. I forgot.
It's all holiday. All right. So have a good one. Stay safe.